what we're going to do today is we're going to talk about volume and how it can help you in relation to binary strike selection and a couple other things related to binaries. Before we get started, first things first, we always go through the disclaimers, put those up for you. Of course, you can find out more information at ApexInvesting, but also just understand the trading period, no matter what you're trading, involves risk. And make sure that you seek out your own independent advice. This is not advice. It's it's you making your own decision. We're just educating you and not making any specific recommendations. This is unique information provided by ApexInvesting. And then in addition, the final risk disclosure, futures, options, and swaps, all those involve risk. They may not be suitable for every investor. They can result in financial loss. One thing you will notice is that there is nothing on here that says you will lose more than what's in your account. You don't get margin calls when you trade on Nadex. Nadex, you put up the full risk of your trade when you put up that risk. And meaning that it's not like you put up $100 risk and then all of a sudden you owe $500 and you only had $400 in your account. Now you owe money. Or worse. You go into futures, you have $5,000 in your account. Some major move happens, a gap happens, whatever. You could be very, very upside down. In Nadex, you will never be risking more than what you're putting up to place a trade. So no margin calls to worry about at all. Now, some of you mentioned that you don't yet have a Nadex account, and so I wanted to show you where to get a hold of one of those. And what you want to do is you want to hop on over to nadex.com, okay? And right out here under Trading, click on Demo Trading Account. And once you click on Demo Trading Account, then fill in a username, first name, last name, phone number, and email address. Click Apply for Demo, and you'll get an email within a few seconds. So if you haven't done that yet, do it right now. It takes literally about 15 seconds if you type slow, okay? And you'll be able to access a demo account. Now, once you do that, you'll be able to log in right up here. Just click on the login button at the top. And again, you'll check your email. What I do suggest is that you go in and log in and probably update your password to a secure one that you'll remember, because you probably will forget the one they give you, those automated generated passwords. When you log in, go in here under My Account, and there's a couple things you can do. Under Settings, you can go to Password. You can update that password to what you want. Also under Preferences, there's some things where you can make it where it'll allow multiple order tickets, and you can decide how long before you want it to auto log you out, and you can set those preferences. So if you want to use more than one ticket at a time inside the panel, then that's how you'll do that. Okay. There's a lot of other helpful things in here. If you ever have an idea, a comment, a suggestion for Nadex, you can use the Message Us and send that over. And they do listen. They've added a lot of improvements based on feedback that traders have provided. So definitely check that out. But very simple to get that account. Now to get a live account, and let's say you want to get that demo account, they're going to give you 25 grand to start with. Okay, so and then you can trade with it from there. $25,000 of funny money, paper money that you can trade, so no risk on that. Just spending time learning how to do it, making your mistakes, getting that muscle memory down. And once you do that, then you can also create a live account. And you just go create account. It takes about 5 minutes, unless you have to submit. You may have to submit something or whatever, But basically about 5 minutes to go from live to funded. And once you do that, then all you have to do is fund with a $100 minimum. Obviously, most traders fund with more, but the only amount you have to fund with is $100 to open a live account. And there's no day trading requirements like in stocks. You have to have 25 grand. There's no, getting assigned or having to take assignment of stocks or having to make or take delivery on futures or, anything like that you have to worry about. Also, if you place one trade, doesn't matter if you do 100 contracts or one contract. If you risk $500 or $3, if you do one trade in a live account, you can call Nadex up. Their number's right here at the bottom. And after you place one trade in a live account, they'll extend your demo out for a year. And as far as I know, I don't see any reason why they wouldn't. They'll continue to do so. As long as you're placing some trades occasionally, they'll continue to extend your demo out. And the good thing about demo is you're learning how to trade. You're able to test some ideas. Trade your system in your live account, test your ideas in your demo account. And, so I'm always testing out demo ideas and, of course, placing live trades as well. And so it's good to have both of those. Okay? Now, you're probably going to want to learn a few things. Beyond this, some of you noticed were brand new. And let's see here. One thing I think we can do is go in and we'll want to make sure you know where to get access to some recordings on everything. So I know some of y'all are brand new, and you're going to want to find out some more information, where to get some basic education, some 1, 2, 3. We'll go into some of the basics tonight too, but just to make sure that you know what to do and how to access everything. And so what I'm going to suggest you do is hop on over to ApexInvesting.com. Okay, and after you do that, you can click on Get Free Access. No credit card or anything like that is required. You can hop right on in there, and that will get you going. And let's see here. Here we go. And then just log in. Once you log in, then you'll be able to see an education section. You'll be able to see webinar recordings. And when we put the webinars, like for Nadex right here under bonus webinars, we also post them in the forum. So they'll be posted in our forum. But and we post all the webinars in here. Pretty soon we're having a new video plugin that's coming out that's going to lay a bunch of stuff out in certain tracks and orders based on what you want to learn. But you can go right there and access the recording. So if you want to watch last week's recording, then go over to bonus webinars. And like I said, it was also posted, I want to say, under style in the forum section as well. If you're brand new to Nadex and you're just wanting to learn about getting started, how does it work, what's going on, how to use the platform, how do the spreads work? Of course, tonight, how do the binaries work specifically? How do futures and Forex and Nadex and all that come together? What does all that mean? That's Nadex contract specs. That will help you out. But these are all step-by-step videos. Okay? So the webinar recording for tonight will be in here under bonus webinars. Yep. That's where we'll put that up. It'll probably be in there sometime tomorrow. Okay? So we just got to render it and upload it and all that fun stuff. You're going to have questions about Nadex, ideas that you have, various trading questions. We have traders posting questions all the time. And, sometimes they're very creative. But you can go in here and, go ahead and post your questions under general trading forum or under the specific section. This is like psychology mistakes, or things you've learned or whatever. Stewart is about money management. Schedule what time of day you want to trade, day or night. What's the best thing to focus on? What are you going to trade with? What are you going to use? Interacting with other traders. Structure, that's trading computers, internet access, trading platforms, data feeds, stuff like that. Strategy is different ways you can trade different instruments. Systems is rules for entering and exiting. Style is when and how to edit your trading system. Like basically, it's reading the market. Scan is finding the best contract to trade, such as using the scanner that we have up here that's free that you can use. Okay. And then synchronize. That's putting it all together. And then survey is looking back over what you did that day. And going, what I do right, what I do wrong, what can I improve upon, okay? And hopefully, that right there will help you out quite a bit. Just having that access to be able to go somewhere and talk, just about Nadex, and all this is free, okay? So all these webinars, the scanner, you can go in and use the forum for asking questions. And the scanner, we'll talk about that some tonight. You'll be able to go in there and use it and access it. And it'll make finding things you want a lot easier. Also, what it'll do is it'll give you information. A lot of times people come in, they don't quite know what contracts they should be trading. And because, it's futures, and they haven't traded futures before. They're not used to, picking a future contract. And so under Nadex information, we have a tab here that gives you a lot of information on it, such as when does a market roll over, what is the symbol that it's rolling over on an underlying contract. We have the current underlyings. So if you want to get all your symbols set up right now, there they are. Okay, there's all the symbols for all the markets and what symbol they're following in Nadex immediately. Important Nadex links like the results page on when they post the actual what price did every contract settle at. Contract specs pages, futures rollover dates, so currency Forex futures, so if you're using those for volume, and how you can use those. And I know we're making some updates on our toolkit right now to deal with continuous contracts and all sorts of stuff like that whenever you're looking at volume. And then again, big thing, the Nadex calendar, knowing when to look at the rollovers for these different contracts, so that way you do update your contracts. It's not that it's hard to do without this calendar, it keeps it straight for you. It's one simple place to go. Because inside every contract, you're going to notice really quick that it's going to state what month you should be looking at. Okay? So, if you notice right there, it says like June. So that automatically tells you what month you should be looking at if this is new to you. And the reason I'm bringing that up is because it's really important about you getting the right contract to look at the right volume whenever you're doing any kind of trading system. All right. Let's see here. Now, we got that out of the way. Everybody knows where to get some access, where to get resources, where to get going, and where to get more information so you can learn more. And we have a lot more to offer you there too. That's just the basics right there. I just wanted to get that right there in front of you. So tonight what we want to talk about is volume analysis. If you're trading, you're used to reading charts. Maybe you are, maybe you aren't. One of the things that's real easy to drop out of the picture is volume, and I don't mean volume of binaries. Okay, that's not going to. Honestly, it doesn't matter. What matters is the underlying market, because this is something that a lot of people don't understand or have never been taught, is that the market exists to fill orders. Okay? That's why it literally exists. The marketplace exists to fill orders. Why does Walmart exist? Besides to make money and all that, to fill orders, right? Between you and Mrs. Baird's bread, or Del Monte, or Huggies, or whatever it is that you're buying there. They're getting from a seller and giving it to a buyer. Okay? The market exists to fill orders. The grocery market that you go to exists to fill orders. The stock market, the futures market, the Forex market exists to fill orders. That's why it exists. So what moves it? Orders. That's it. Not indicators, not anything else, orders. And the market is going to go to where the orders are. Okay? And when you see orders picking up, the market's going to move to that point as well. So the market exists to fill orders. And you want to use that knowledge to your advantage. You want to look at where are those high points of order flow, so you can know where you should expect there to be orders located on any given market that you're trading. And so that's a lot of what we talked about last week. We'll talk about it a little bit more this week again, going back and just finding these are not volume spikes, okay? These are just what I call high volume bars. And it's not really subjective. If you look at it, it doesn't, it's not hard to pick out what's high volume and what's not. And I mean really high volume, okay? And so you want to look at that volume analysis. That's going to help you when you're trying to determine, and this is one of the most important things, if you're trying to choose out of the money binaries, which I will tell you right now, out of the money binaries, which is a binary that has a risk of less than $50, are the hardest binaries to trade. They have higher profit potential, but you have to be right about time and direction. Okay, so how far it's going to move and how long it's going to take to get there. Okay? So it's going to be very, very important that you do understand that when you're doing out of the money binaries, you really want to keep into consideration, that analysis of looking at, putting all those different pieces together in there. And so what I would suggest is that you definitely go in and you start looking at expectation of movement. We'll talk about that tonight. And you look at expectation of price area that it's going to actually hit. Okay? So what do I mean by that? Well, let me pull up just a basic chart for you. And we're going to do some, like I said, some basic volume analysis. So file, new, chart. We'll go over here and we'll look up, let's see, what contract should we check out first? I'd like to find one right now first that's just not rolling over because it's a little bit easier to go over with you to begin with. So, let's see, oil just rolled over, all the indices just rolled over, all the Forex just rolled over, so there's a lot of rollovers happening at once. We may have to go with the rollover one, and I'll teach you how to handle that. But the main way to handle it, we'll go ahead and we'll do it. Okay, so we'll go to Russell, okay? And we'll click New. And so I'm going to add that on, but I'm also going to add on something else. Add on two more things on Russell. And I'm using NinjaTrader, by the way, and I show you how to get access to it for free and the data for free inside of our website under Getting Started under Home. So you can always check that out. But we'll put these on here. All right, and I'm just going to talk about high volume analysis. But I want to teach you, this is an important lesson to bring up. Really, actually, we've rolled over now, so I got to update that real quick. Let me do that. So 1 second here. Here's a trick for you. By the way, you go to TF. I'm going to click it to get rid of it, and then click it to add it right back. And now I have 614. Okay, so I don't even have to look them up. So I know these have rolled over. I know ES has rolled over. Oil has rolled over. Let's see here. We also got Dow has rolled over. And we have the NASDAQ. There we go. Okay. So I'm going to put those on there. Just by doing that now, when I go to File, New Chart, now I'll be opening up the correct month. Remember I said we want to have the right months on our chart, so I'll need to do it on my my futures Forex as well. But I'm going to go over here and we're going to go to the Russell. I'm going to add it on. I'm going to add on the range for 60, and I'm going to add on 10 minutes. But I want to show you something a couple times here so I can show you the comparison. So let me do this for you. Okay, this is called a continuous contract. When I put pound pound dash pound pound in there, what that means is it'll link all the months together. We're actually going to have a release later this week that'll do this automatically for you, which is pretty cool. But right there, and let me make this one 10 also. And then this will all make sense in just a minute. So let me get the chart opened up for you. Okay. So I meant to put that over on light on close. It's a little easier. There's only one thing I have to change. I'm going to hide them all. And I'm going to show you the two different volumes, because since we're talking about volume, this is a very important volume lesson that you need to learn as a trader. It's one of the things that it can take you a long time to figure out if somebody doesn't show it to you. And when you're looking at volume and you're looking at a specific month, you're looking at that month, because futures contracts roll. And so they're not, if you're looking at a monthly contract, you're actually not looking at the volume from the high volume bars. And like I said, this will all make sense, but this will be probably one of the best lessons. It's very simple. It's not super profound, but it's very important. So, okay, so we got all that. All right, getting all the data opened up there. Okay, now I'm going to go in here and we're going to add on some information. We're going to add on volume. Standard, regular volume, just VOL for volume, okay? And I'm going to assign this volume directly to my two 10-minute charts. So I'm going to put it on that one. I'm going to say, okay. And instead of new panel, I'm going to choose close there, okay? Right here, I'm going to say assign it to my input series. And then I'm going to choose another volume right over here. And we're going to say same as input series. And I'm going to put this one on my 10-minute one, but on my continuous contract. That's the one where I put TF pound pound dash pound pound. Okay. And then the one other thing I'm going to add in is, let's see, I'll put the channels up top, but I'll put the expected range down below. And we'll tie all these pieces together for you. Okay. All right. All right, so the main things you're wanting to look at is I want to show you the two volume bars. That's the main things I want to look at right here. Okay? Like I said, we'll come back and we'll put that up there. There we go. Let me shrink that down. And I want you to notice there's definitely, it'll be very similar. Like right now, the day, okay, working at continuous. This ought to look about the same. Probably is pretty much the same. Let's see, 10.695, 10.695, because this is a continuous contract. And the active month right now is June. Okay? Somebody says I can't see my screen. Can anybody else see my screen? Everybody else has it? Okay, screen's fine. All right. All right, so if we go over here, it'll be the same for a while, but then if we keep going back, okay, it's weekend, so that's why there's nothing there. I have 24/7 selected. You'll start noticing some differences, especially the further back we go. There we go. There we go. Now you're starting to see a big difference, okay? Like right here. All right, you see that massive difference between those two contracts right there? Like Over here, volume is dramatically different. Okay, they don't look the same. Okay? Why? Can you tell me? These are both Russell, both TF. One is continuous. That's that pound, pound, dash, pound, pound. And one is for the specific month. So you tell me why are they different? Why is this volume different on these two? So yeah, continuous links them together. Okay? And it's sort of cool. Inside Ninja, you can even see something in here. If you go to Instrument Manager, and let's say I look up TF. Okay? Right here. And I do a search on it. And notice how it says contract months, expirations, and rollover dates. And it's 44 contract months defined. This actually tells it when to roll over to a new month. Okay, so here on March 14th, it told it when to roll over. Okay, so it said rollover date 3/13/2014. Okay, roll over to 6/14. Okay, so that continuous contract is using this data table to know when to roll. All right. So obviously, whenever people are using that, they're using the most liquid month. You want that contract that's being traded the heaviest, because otherwise there's not very much volume there. Your bid-ask spreads are real wide. I'm talking about pure futures traders. Okay, they're trading like ICE TF. Okay, and so the volume's not as heavy because everybody's trading March. They're not trading June up here. And let me go over and get the indicator toolbar. It'll make it a little bit easier to point, so you can see what I'm pointing at. But right over here, this is right here. You're looking at the actual June contract, and let me see if I can make that a little bit easier for you. There you go. Everything's a little bit larger now. Maybe too large, but it's there. Anyways, you can tell there's definitely a major difference in the volume. Just look at the numbers alone on the side. Okay, but we move over here and they start lining up. Okay? So what you want to do is you want to make sure you're trading the liquid month. But if I'm looking backwards, okay? If I'm looking backwards to try to figure out what the high volume bars are, which is what we're going to go into, I need to look at the continuous contract. Does that make sense? Because by looking at the continuous contract, I see the consistent high volume contract that's being traded. I'll see, March when March is the main month. I'll see June when June is the main month. I'll see December when December is the main, whatever. So I'll see that high volume month. Okay? So it's very important that and this actually works the exact same on Forex. Okay? On Forex, you need to be looking at Forex futures contracts. So Doug asked about how does this apply to Forex. You actually need to be looking at Forex futures, because if you look at Forex volume on Forex spot, you're not looking at volume. You're not looking at contracts bought and sold. Okay? You're actually looking at what's called tick volume, which is how many times did the price change in that bar. So you need to make sure you're looking at that. Okay, so even on Forex, now obviously, now most of the Forex pairs that have heavy volume, like actually readable volume, are going to be your major pairs, which are going to be your dollar-based pairs: dollar CAD, dollar yen, dollar franc, euro dollar, pound dollar, stuff like that. And I went over a lot of that stuff in our webinar last Thursday in detail. So definitely send our Thursday AM webinars, and that one's up. You definitely want to check that one out. But I went a lot into Forex futures volume. But the big thing I'm trying to make sure you understand right now is you need to look at this. You can't trade a continuous contract. So if you're actually trading futures, Kelly, you're trading the actual contract month, because you can't buy a continuous month. What is the month that you're buying and selling? What's the contract you're making an agreement upon? So, but you can go in and, look at the volume. And I don't want to be looking at this volume for, there's a volume of 1, of 2. I don't want to be looking at that. It's not going to help me at all. Okay, for determining high volume. I want to be looking down here. at 103, 300, 1,000, 2,000, 3,000 contracts. That's the numbers I want to be looking at when I'm determining what high volume bars are. So I thought this was really important to bring this topic up today, considering we just had all the major rollovers on all the Forex futures, on all the index. That happened last week. We had all the index futures rollover on Thursday, Friday last week. We had oil rollover. So, most of the markets just rolled over. So you want to be aware of that, because if you go in and you pull up like 614 and you pull up 10-minute bars to analyze volume like I taught you last week on last week's Monday webinar, then you're going to be seeing a lot of this, and you're going to be like, there is no high volume. Like there's 1 and 2 and 3. Yeah, you need to pull up a continuous month to be able to look at that. Okay? And there's some other things about that continuous data if you want to get it live. There's all sorts of issues with that too. But you can do it all. It's just a lot of times it'll be delayed depending upon what broker you use and what kind of setup you have and all that. The main thing I want to make sure you understand is how to access this information and what to look at correctly when we're looking at high volume bars. So hopefully you understand that really, if I'm looking for high volume bars, I can literally just drop. Okay, I don't need to worry about the current contract month. I want to look at the continuous contract. Now, we were at a point last week where we were looking at several months of data. And it was fine, because these contracts on Forex and on indices, they'll go for 3 months. They roll quarterly. So, or not Forex, but on futures, they roll quarterly. So, you can just literally drop that contract off. But you want to be aware of it, and you can tell too as you start rolling back, you'll see nothing happening. So if you're ever making the mistake and you forgot to look at the continuous, you'll know because there'll be no volume there. A good chunk of the time, I don't need to roll back more than a month or two. Okay, so even though like say oil and natural gas and Forex and stuff, all these will roll over quite often, I usually don't even need more than a couple weeks to use this high volume contract method. So I don't always need to use the continuous contract, but right now, it's obvious that I do, because I don't have any volume previous to the last couple days at all on this contract. Okay? As far as what is a rollover, okay, that's a great question. It's a fair question. In futures contracts, okay, the reason it's called a future is because if I buy or sell a future contract, whether it's on gold or whether it's on an indice or whatever, it's saying I'm willing to buy or sell this for this price at a delivery at this date and time in the future. Okay? And so if I want to buy a whole bunch of oil because I own an airline and I want to lock in my price so I can make, prices for tickets because I know what my cost of fuel is going to be over the next 12 months by using futures contracts to do that. Or maybe I own a cereal company and I want to be able to sell cereal to grocery stores, but I need to know what my price of my corn is going to be and my wheat is going to be and all that's going to be, or to make, and the sugar and milk, whatever it is that you're making, you need to know what that price is going to be in the future. Well, it's an agreement for a delivery on a certain date, meaning they're actually going to deliver. If I take it to delivery, I could always close the contract, but if I take it to delivery, they're going to deliver the wheat to a certain train station where I'll have trucks there to pick it up, and we get all that. That's a whole futures course, and we have stuff about that on our website that teaches you about that. But that contract's going to end, and a new contract's going to start. Okay, and so a rollover is simply whenever they roll from one month to the next. And so sometimes it's for hedging. Sometimes hedging meaning making sure their price is there. Sometimes they're actually using it. So like Southwest Airlines, they used it, and that's actually one of the reasons they kept the rate so low after in the early 2000s and everything. Whenever all the stuff happened with the airlines and 9/11 and all that, is because they had all of their fuel hedged off. And because they use future contracts. But if you go in and let's say you go to CME, okay, just looking at their site here, and these are the underlying markets that the indicatives are being made off of. And we go look at, say, let's just say you're doing soybeans. Okay, so we'll go to agriculture. And we go down here and we look at soybeans. And you'll, there's not really any volume right now tonight. Let's see if we get some historical data there. If it'll give me any better data. Basically what they're going to do is they're going to roll over on a certain, there we go, that's what I wanted. Okay, so at the close, what was, a certain volume that was happening, 120,000 contracts. But that's for delivery in May, okay? This is for delivery in July. This is for delivery in August. So Nadex is going to follow like the May contract month. Again, you don't have to be some guru about futures, okay? Just know that it is May. And how do you know? You just literally look at the contract in Nadex. It tells you May. All right, so don't feel like this is some like big advanced thing. One of the things I love about Nadex is it's so simple. They've made it so easy for you. Okay, you don't have to get in there. You don't have to get all complex, and you don't have to worry about rollovers and everything else. You don't have to be some master of all futures education. You don't have to understand 20 different tick sizes and tick values, and there's so much you literally don't even need to know to how to do. It's really cool, but you need to make sure you're looking at the right contract month. Okay, and the cool thing is, you don't even have to refer to our charts to do that. All you need to do is pay attention to the name in the contract on Nadex. All right? And so we teach you how to do all this. We walk you through it, but it's really not hard. I mean, pick any contract. Okay? Oh, they just logged me out because I just logged in on a different page. And so if we go over here and we pick any contract we want to, soybeans, click it, it'll tell us right there, May. Going to be using May. When soybeans opens up, we're using May. Silver is on May. Crude oil is currently, and they're all on May right now, seems to be, but different ones will not be May. April on gold, but it'll tell you, like right there, see May. If we go over here to the indices, it's going to say June on a bunch of these. So June on the Nikkei, we're going to see June right there on the S&P, we're June right here on the NASDAQ. So all that's right there. And it tells you what month. So it's real simple. You just go and choose the month. If you don't know what the name of the month is, if you don't know what the symbol is or how that works, all that's on our website. So we actually show you the exact symbol to be using that day, okay, inside of Ninja or Thinkorswim or whatever platform it is you use. But we actually show you right there under our scanner, okay, which symbol it is you should be using. So we put it at the top of the scanner. We put it on the instrument list. We put it everywhere. It's like right there, it'll say Aussie dollar. But if we look over here to say, S&P, you click that, it'll actually say, even the S&P Ninja Trader symbol, ES06-14. Or the generic symbol, ESM4. M is a month code. But we have videos that go into all of this. You don't need to know all this. So I hope you don't get all overwhelmed on rollovers and all that. Just follow the calendar, okay? Learn it as you go. It's one of those things, you don't need to know how an alternator works to drive a car. Eventually, it's a good idea to understand that if your alternator goes out, your alternator is what charges your battery. And so if your battery dies, you need to run your car around a little bit to recharge up your battery and all that stuff. There's good reasons to learn things eventually, but you don't need to know when to drive a car, okay? So right now, just learn what you need to be looking at. What pedal do you need to be pushing, okay? And we make it really easy for you. And again, we have the forum so you can ask questions. As far as what platform we recommend, just go to Home, Start Here, and we'll walk you through that exactly. So we walk you through Ninja, how to get it free, how to get the data free, everything right there. Okay? Also, inside the binary scanner itself, it'll tell you the symbol at the top. Inside the spread scanner, it'll tell you the symbol at the top. So all that information that you could possibly need or want is what are going to be right here inside of it. And like I said, also on the spread scanner, doing that, knowing what to look at. So, but the lesson I wanted to bring you up to speed on, okay, is if you're wanting to look at high volume bars like I taught last week, and you go in and you pull up these 10-minute bars, and you could not have watched the lesson, but let's say you're like, okay, I need to look at high volume bars. And all of a sudden you look at this, you're like, wait a minute, there is no volume. There's nothing. What do I do? Do I look at last month's? What do I do? Now remember what I say. Most of the time, I'm not ever looking even more than a few weeks back, more than a month back. I may occasionally, but most of the time I'm not, okay? Well, the indices, they go for 3 months at a time before they change contracts. So it doesn't really matter whether or not I had a continuous last week, okay, because I had 3 whole months. This week, I only have a couple days of actual, volume. So now in about a month, I could probably just be looking at, the current June contract because I'll have a month of volume. But right now, I don't. So right now what I'm going to do is I'm going to just drop this one off just to make it a little simpler, okay? And then we're going to go over here. And now this is the volume I'm going to pay attention to. Okay? So right here, these actual contracts. And then I'll just zoom way out. Okay, what are the high, volume contracts? And that's what I'm going to pick out. So if you caught the lesson last week where I showed you how to use this information, and so now I'm sort of building on top of that. Once you've learned that, hopefully a bunch of y'all practice that this week. I saw a lot of posts and stuff in our rooms about traders looking at it. And you can pretty much go, you know what? I mean, just looking at this, you could say this pretty much encapsulates everything that one could consider high volume. If we go over here, we'll make this a little thicker, set it as the default. You could say, pretty much any bar above that, I think it is safe to say is high volume. And then we scroll, we back down on it. Yep. And so yeah, that pretty much captured all the high volume bars. Okay. I could get pickier if I want to get really the highest of high volume, move it up a little bit higher, trying to sort of weed out most of the stuff on it. So go right there. Now if I got the high volume bars, that's good, but now I need the high volume prices, right? Because there wasn't any contracts traded up here. So I might need to go in as well and add the continuous historical as my main data series. Okay? Or even as the one below it, however you want to do it. But I can go down here, and the way I do it, I just literally type it in. You can add it to your instrument manager list if you want to, but I just type it in. And I go TF, pound, dash, pound, and hit enter. Okay? And then hit OK. And then now I have that price down here below it. See what happens is I go back. What happens is we'll get less and less volume on that previous contract, and it'll be really hard to read anything because there's not much price action happening. Okay, so see, there's a lot more lines going on over here. So I can get this out of the way, get all this out of the way, and now we're focusing right here for those high volume bars actually took place. Okay. Thomas, yes, I have tons of information on how to set up everything in Ninja. So it's right under Education, Ninja Trader. Lots of stuff in there. So, it's A to Z. Actually, we had a webinar, last week's webinar was called A to Z. So, on Thursday. Probably be a good one. It's under bonus, under Thursday AM webinars. So I actually walk through setting all this up step by step. But it was a little more practical. So right now I'm more going to some of the concepts you need to understand about what month you need to be looking at. Because last week I taught about using high volume bars, but I didn't talk about dealing with rollover on high volume bars. So you're correctly doing price analysis. So like right here we can see, okay, high volume bars, and then what I do is it's really simple, I just mark, okay, the prices. So here you'll go like the high and the low, these really, these bigger extremes. And if the new bar I'm looking at that's high volume is right there, I'm probably just not really going to worry about it. Like right there, we're basically right at the same level, okay? So I'm just going back and I'm trying to find, where are these these biggest high volume bars. And you'll start being a little pickier and more picky on what a high volume bar is. Watch this. See, you'll get pickier and pickier as you go back because you're like, okay, I don't want to mark up all this stuff, and you'll move this thing up. Okay, let's try that right there. And that way you're getting less and less because you really don't want a whole bunch of lines everywhere. It's not going to help you. So I'll put it at the high and the low of these bars. We'll go back further. Try to find the next big high volume bars. Okay, there we go, like right over here. And we sort of got already, but that high and low, so it's sort of all coming together. It's going to be a lot of volume right in this section. Back a little further. Let's see right here. And by the way, you don't want to just like drown your charts in lines. Okay, then it becomes like unreadable. Okay, you know, the analysis paralysis thing going on. What's interesting, you get these lines drawn on here and you start noticing like what the prices do and how they just bounce right off of them. And they become they're actually called magnet prices. So look at that. See, this goes down, bam, right there and nails it. Okay? Comes right back up, right to the next one, next to the next one, back down to it, and it'll just keep doing that. It'll come right to these magnet prices. So right there we got the same thing. Goes in, goes forward, boom, right back down. It's oscillating right around that one. Pops up above it. See, they're all lines we made from historical high magnet areas. They're going right to where the volume bars are. Where do you think, how do you think understanding what a magnet price is, how do you think that might help you as a trader when you're choosing a binary contract? Like say an out of the money binary contract. How could that help you? Yeah, a target projection. So, like, where do I think it's going to move to, right? So it actually gives you a realistic price target. Yeah. So you're going to need that, right? Because you didn't know what price do I expect. If I think it's going to go through this area, where do I think it's going to go? Okay? And so now we're going to add on another thing. We're going to add on expected range. Okay, we're just going to look at it this way. This will be the easiest way to begin with. And I'll put this on the continuous contract for now. Where we go? Choose close. There we go. Okay, so if I have, like, I think it's going to hit a certain price, and if I said, okay, well, I think if it's, and this is basically what this tells me is how far the market should move during an hour. Okay, like it should not move further than this. Okay, and I'm going to show you how to know also when it should break out of that here in a moment. But how far should a market move, during an hour? So without having this additional piece of information about volume I'm going to teach you in a minute, would you want to choose a contract that's going to expire, say, at 3 o'clock for a price down here, like right here? Let's say if I was targeting this price. Okay? And I'm waiting for it to break below this level. Okay, well, it finally breaks below it, 1438, and I'm saying, hey, I think it's going to move down here by 3 o'clock. Now, it did happen to, okay? But would that have been a wise decision if that's way outside of the expected movement during that time frame? So we have a target of where we think price is going to get to, and my guess is a lot of y'all are actually pretty good at that piece, okay? You're pretty good at saying it's going to get to here. But what happens a lot? It expires before it gets there. Would you agree that's one of the biggest challenges you face as a binary trader? So you can get in there and you can pretty decently call, like, hey, I think it's going to go here, but you're like an hour or two too soon, right, on your expiration. So this one helps you with your price targets, and maybe you have a method that already works. Maybe you line up fib levels and support resistance and whatever it is that you use. But what you also want is you want to have a correct expectation of how long it's going to take to get there. Okay, or is there a reason for it to break out and get down there during this time frame? So we're using we're using high volume bars, okay, which not that hard to come up with what a high volume bar is. Okay, just back out on the chart. Remember, we just looked up here. Okay, we didn't even do today's. Okay. Find some high volume bars and start marking up the bars and go back, we only went back a few days. I mean, we didn't even mark up that many. All right? And then once you do that, then go, okay, that's where I think the price is going to go to when it breaks a certain level. It's hard to do when you're at new highs, because where's it going to go? That can make it a little bit challenging, right? So always be aware of that when you're breaking and making new highs. It can be a little hard to figure out where it's going to go next. So, but when it starts breaking back down, you can have a pretty good target on where it's going to drop down to. Same thing if you're making, new lows, meaning recently, recent new lows, like in the last, year or so. Anyway, so going down, so if it's going to get here or here, or, even down to this point, whatever price you're going for, you want to have a realistic idea on time frame. Now, if you thought, hey, if it breaks this level, okay, during this hour, you think it's going to go down to this point, that'd have been good. But if you were targeting this level or this level, that'd been pushing it for your actual expectation. So again, you want to combine target price expectation, that's high volume bars, okay, with expectation of movement. So that's how far should the market move on normal, that market, that hour of the day, that day of the week. That's what we're showing you here with the expected range, okay? Now, the next thing to help out with that, so let me show you this. This helps out quite a bit. So put this on. We'll go and we'll choose the continuous. Okay. And then the next piece I'm going to go in and show you is, we'll change this to volume. And I'll even label this volume down here. All right. So now what I'm going to show you, so we got high volume. We're sort of getting rid of this information up here. We're not looking at it right now because it's not very helpful because it just rolled over. Okay? And we figured out, what the high volume bars are. Once we got that down, by the way, I watch it to add on some new levels, but I don't like just stare at it all day. It's like, oh wow, big volume bar. Let me go ahead and add those magnets in. Okay, and I'll clean it up. I'll go through it. Sometimes I'll just delete all my magnets off and re-add them back on for the last few days because you'll get so many lines that it becomes a bit, pointless. And you also see which ones are really working. Like this line right here. Like it came down to it, broke through it, came back up to it, Don't really need necessarily this one. So you can sort of delete stuff when it's sort of busting through it really well. Like that one actually had bounced off it a couple times. This one, get rid of that. So sort of clean them up as the market's moving. Okay? All right, so a question just popped up. Do I always recommend out-of-the-money contracts? Actually, I recommend you don't touch out-of-the-money contracts until you've learned how to trade in the money and maybe at the money contracts. Out of the money contracts are the hardest contracts to trade, period. Because you have to pick time, like how far it will move and how fast it will get there. If you do in the money, it doesn't matter if I'm right, okay? I can choose an in the money. I can say, I think it will go down. And I can sell this strike right here, okay, right here, 1190. And if it goes down, if it stays flat, if it moves up a little bit from where it is right now, in the next 30 minutes, in the next hour and a half, whatever, I still am profitable. Now, you also need to have good risk management with that, okay? So, and then Senior Pippin, continuous contracts are always pound dash pound. So 6J pound dash pound for yen. Anyways, so, but right there, so in the money contracts are a lot easier to trade. Now, they are higher risk if you're not managing your risk, okay? In the sense of if you're not, basically saying, hey, I'll get out if it hits this. But you need to make sure, again, make sure you always, on the continuous, always have that dash in between. So the two symbols, space, pound, dash, pound. But does that make sense, Preston? Like why I always recommend, I don't actually recommend it out of the money to begin with, because you have to pick distance and time. If it does not move far enough, fast enough. If it moves the wrong direction, you'll lose. If it moves in your direction but not fast enough, you'll lose. If it moves in your direction but then pulls back, there's a lot of little pieces that go together with out of the money. You can make a lot more money with them. So it is worth learning and mastering. But you need to master volume and expectation of movement to know where should I realistically target and how long should I realistically take it to get there, and should I think it'll break out right now. And so right here, you go in and the market's heading down. Now, here's what I'll do. Notice how I have expected volume and actual volume right here. If I see that actual volume is exceeding expected volume, this is very important for right now because we're in this rollover period, okay? If I see that actual volume is exceeding expected volume, that's when I can go for a further out contract. I usually won't go for that much further out, but I see it picking up, like right here, it breaks through, and see how actual volume, that little blue arrow is actual volume. So that's, if you're looking at a volume chart, that's what you're going to see, 752 contracts. But we're expecting like 500. So actually we're getting more and more volume right here at the end of the day, on this day right here. So this is looking at the 28th. And it's going further and further and further and exceeding that volume. That's when I'm going to go, hey, I expect it to go further than this range because this is how far I normally expect the market to move for this hour, for this day of the week on the 28th. Now, it'll be different on every single day of the week, every single day of the month, every single hour of the day. But I only expect that to be broken when I see the expected volume broken. And it's broken, bam, it gets broken. Like, look how the volume keeps getting broken. So now I can go out for more. That means this is when I'm going to start using out-of-the-money contracts. When I see actual volume exceeding expected volume. Okay, when I see actual exceeding expected is when I'll be looking at that. So I hope that it helps, Preston. So I don't always recommend out of the money. I do definitely say you want to master out of the money, but get your in the monies down first, because then you're just mastering correct direction. Okay? And then you'll be worried more about correct direction and time with your out of the monies. See, why not choose all day contracts? All day. You mean dailies on the binaries, Nestor? Is that what you're talking about? If you're talking about dailies on the binaries, then they won't move as fast. Binaries move faster the closer they are to expiration, so you're going to pay a lot more money for that. Okay, so meaning you might make $10 on a $30 risk instead of making $70 on a $30 risk. So they're going to move slower the more time there is till expiration. Doesn't mean I don't use dailies. I use dailies on a lot of stuff, but I want to look at my risk reward and see, is it worth it? So if I go over here and I'm looking at, Forex would probably be one of the best examples right now, and just because the contracts that are laid out. But I go and I look at them and we line up. We'll try to get as close as we can on some of these. Here, let me narrow this down a little bit. Get rid of the end fluff stuff. 5 to 95 gets rid of a lot of stuff for you. And then it's like $6 on 90, 97. See, $20 on 90.95. Okay, that's just one more hour. I'm paying $20 for that contract instead of $6. Now this only has 4 minutes, and that has an hour. Okay, but it definitely shows you the difference that time has on the impact of your price. So a lot of people will be attracted to this, but they don't understand. Yeah, you only have 4 minutes, so you better be very right about being able to move that far, that fast. Otherwise, you're just throwing away money. This is actually a little further out. It actually costs a little bit more, even though it's further away. 9100, it's 2350. So it'd probably be more about 25, 26. If I want to see exactly what it'd be worth, I can actually use the simulator, and it'll tell me what the price of the binary will be worth right there at the top. We have tutorials under the help section. There's a whole tutorial section that teaches you how to use it. But yeah, so I want to use, really, I'm trying to get the most ideal. I don't need to cut it as close as possible, but why would I buy a 3 a.m. when 22.50 for an 11 p.m.? Or if I go down here, that one's 32.50. Now, if I'm choosing between 3 o'clock and 7 o'clock, I might actually go ahead and go with the 7 o'clock, because look how there's very little, what you could call time decay, theta decay, happening in the binary at 7 a.m. to 3 a.m. There's only like $1 or $2 difference. If I go down here, 34, so now I might be motivated. So at a certain point, it'll start building up on you. So here's only a couple dollars difference. So yeah, get the other 4 hours. But here, we're talking 30% more cost. You saw an article that I wrote, over on Benzinga about trading the Nikkei 225 at night. So yeah, you'd have to use the Singapore index, SGX. Correct. So to do that, you don't want to use the CME. You need to use the SGX, Nikkei 225 contracts. So to do that, you'll need to go over here, because that's a longer answer. But let's see here. I know we have it in here. And I tell you basically how to set it up. Yeah, there's Aussie dollar. Just click on that. I know in one of these I have it in here. Okay. For data feed info on that. Okay, there we go. It's a little more difficult to get data on the S&P 500. Or not S&P 500. That's easy to get info on. The Singapore Nikkei 225. It's a little more difficult. So you're gonna basically pay for the data. Just let you know that right now. So you're not getting that free. The big thing we're talking about here is getting you the volume, because you really need volume for proper expectations. You notice how the volume, we're perfectly seeing it bounce off these high volume levels, okay? We're also seeing that it's breaking the expected movement when high volume picks up. So if I'm doing out of the money contracts, when I'm just meeting expected volume, then I'm sort of asking to lose, I want to be timing my out of the money contracts when I see expected volume being broken. That's when I want to be hopping in. And I'm like, hey, I think it's going to go short. Well, great, maybe you're right, but it only moved like 2 points in an hour. Well, here, it moved 7, 8, 9, 10 points in an hour. If we go from like 1430 to 1530, we got a nice big 10-point move, but all of that was seen by expected volume breaking it. But hopefully that'll help you, Keith, on how to get that data right there for that. Let's see here. So yeah, we'll see. Preston, exactly right. So by using volume, you know where the price will go to eventually. Now you can use there's different methods. I mean, I use a method called MVP and Apex. If I throw that on my chart, put that on here, I'll let you see it. And that helps me, look at direction. And then your Apex, so like that's good. Hey, the market's going short. Great. Okay, so we've been going long, short, long, short. It's okay, it's going to go short now. It's going short. Trigger price when it breaks this, expect it to go short. Okay, I'm still not doing it. I'm doing it in the money contracts right now. Okay, then I get another confirmation for the market to go short, and right after that, volume starts exceeding expectations. Now I could be looking at maybe this level. That'd be cut it pretty tight. Well, we got about 20 minutes left, but I may go for another level if I'm going after the next hour's expiration. Big thing is also I close. Well, there's targets. Just because it's going to get there, very important question on your out of the money contracts. Should you expect it to stay at that price? So just because it gets to that target price, should it just stay there all the way until expiration? No, exactly. Definitely not. So knowing that it's probably not going to stay there, now, I mean, maybe you chose this contract, and it came down, but it easily could come back up and erase all those massive profits that you're up, right? You sold for, $80 and it came all the way down to 10, then it could rise all the way back up. You want to take profit. So there's several ways to do that. Okay, one of those is simply taking profit when it hits the strike that you're going for. Like, so you go down here, let's say you chose the strike that was at this high magnet volume level, and you just buy it back. Okay, I call that the 57-43 rule. Okay, or 43-57 rule. So if I sell, I'll buy back at 57. Basically, here's the reason: is a binary will always be worth $50. Okay, when the market hits its price. So if the binary strike was 11.82, the market got to 11.82, the binary will be worth $50. But you have bid-ask spread, right? So that's going to put you, let's say you have a $5 bid-ask spread or whatever. So that's going to put you at about, 47 by 53, okay? But what if it gets like right to within like a tick of it or 2 ticks of it? Doesn't quite hit it, so you don't get filled, okay? Then that's why I do 57-43, because that gives me a couple ticks to be wrong. Like, maybe you were targeting this one, and you can tell if you look really close, like it didn't quite hit that pink line right there, right? So we went down to like 1174.1, and this was down here like 1173.7. So it was like 4 or 5 ticks off of it. So by using that 57-43 rule, I saved myself a lot of heartache, okay? So that's one very simple way. You can set the advance take profit order. You can walk away. You can let it do its thing, okay? Another way, if you want to try to maximize it, is I'll use the actual volume here that's exceeding. So see where you have down close and we're exceeding volume, down close, exceeding volume, down close, exceeding expected volume down here. Down is exceeding expected volume, down is exceeding expected volume. That one is still down, but a little battle right there, exceeding expected volume. But now we get an up close and we're exceeding expected volume. That's a good indication the market is about to go the other way. Okay, a bar just closed in the other direction, and the volume is higher than expectations. So it's time for a bounce. And we get it too. Boom, 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 right back up. So when I see that bar close, that if you were doing a trailing stop, like let's say you chose this is your first target. We had this expiration over here at, say 4 o'clock. So you're sort of trailing, you're letting it go, okay, down close, good, down close, good, down close, good, And then all of a sudden you see that this closes up with exceeding expected volume. I'm done, I'm out. So, or you could just trail at the last high. So a lot of different ways. The simplest way is pick a price, target it, get out of it. But if you want to try to squeeze the money out of the monies, this is a very, I'd say a method that I really like doing. Where I go through and I trail it down. But just waiting for that opposing direction close where volume is exceeding expectations. So, and you'll notice over here when it runs up, and all of a sudden we get a bar closing down that's exceeding volume. Now it just sort of flattens out. So now we went into chopping at the end of the day. And we're right at the end of the day. So that could be a very good way for helping you control your volume. That expected volume, actual volume is huge. So hopefully you're starting to see, last week we taught you about make sure you use the magnet prices. Then we talked about make sure you have accurate expected movement within a time frame. And then now we're adding in the application of expected volume versus actual volume and using that to know when to go for that bigger move, that out of the money move, when to tighten, trail your stops, or when to definitely stick with the in the money trades only. It is definitely advantageous to use the continuous. There's a couple of problems if you're just using continuous. One is you're going to need to have a funded account, okay, with the futures broker, or you're going to have to pay for it, much more pay for it. So like we have some brokers. I'm not going to mention any FCMs on here, but if you go to our site, you'll know who we work with, and we're always expanding, looking for other FCMs that are coming on board. But you need to fund an account there, or you need to pay for the data outright. And the reason I say you want to fund is because you get a major discount on the data. Because for continuous, you actually have to pay for it. So now, it's not much. It's like $25 a month if you have a funded account. If not, if it's like $250 a month. So you got to pay for that data. So we have that information on our site, but you need a funded account, so it doesn't cost you a fortune to pay for it. And none of the $250 is a fortune, but if you only have $500 in your account, if you're new or you're just starting, that is a fortune to you. So, but once you have a funded account, then you can basically connect to both of the live account and like the data feeds that we recommend over on our site. And what that'll do is that'll basically drop you down to the CME discount program. It won't cover like subcontracts like Russell. Actually, IC still have to pay for all of it to get live continuous contract feed. So basically, there's more expense. Also, you want to line up if you're really doing this and you were just doing Nadex. Okay. You'd want to go in and you'd want to adjust your dates to match, and be a little bit of a pain. I'll warn you now if you're doing it. So it depends upon just how much work you want to put into it to avoid having to go back and forth. But you can go in here and you'd want to go in and adjust the information on the rollovers to match right here, the Nadex rollovers. Because like the rollover, like technically like on a Saturday or whatever, right? So, because they let the week finish out because they have weekly contracts. Some contracts have different dates, and so you need to adjust that information so you're looking at the right price. Because every pip is a huge deal to you. Every tick, sometimes when it comes right down to it, odd expiration. So you want to make sure you are looking at the right contract. Okay. You can do the exact same thing on a Forex pair. Yep. So like last week. I've been out a little bit. I just celebrated my 10-year anniversary this past weekend, so haven't updated all my contracts yet. But here, the Aussie dollar, and so yeah. So you can see where I'm using 6A 314, 6A 314, which was fine for using Aussie dollar. So notice I was using the futures contract for the Aussie dollar itself. Now I'd be using either 6A. I can't really use 6A 314 for today. It's not going to do me any good. But because everything's on 6A 614, but also there's no volume on 6A 614 06-14. So if I wanted to do historical analysis, it's fine for current analysis, but for historical analysis, I'm going to need to pull up the continuous. So 6A pound dash pound. And that way I can go back and I can look at all that information. So thank you. Yeah, we had a lot of fun. But I know one thing we're adding in for this whole actual thing is to make it where it will show you just continuous and live. Like it'll actually feed the two. What it's going to do is it's going to merge the two together in one chart for you, so you don't have to pay all that money. But it'll use the live for like right now, and it'll use the continuous for, because continuous basically is yesterday previous, okay, and then live is today. So what we're going to do is we're going to factor in, we'll use the live for today and the continuous for everything previous to today and all the calculations. That way it'll basically make it very easy for you. That's one of the things we're adding into our toolkit, to make that easier. And that's supposed to be done this week. But so yeah, that's exactly how you do it. The 6A space pound dash pound, and then like I said, by the end of the week, hopefully we'll have this where you won't even have to worry about that. My goal is always to make it as easy as possible on myself and everybody else. Okay, so hopefully, I mean, those are the three things I want to go over with you. One, make sure you're looking at those magnet prices on the 10-minute bars. Okay, that's important. Magnet prices on 10-minute bars. And the magnet price is the high and the low of the high volume contract, looking at the continuous contract if there's no volume on the current contract going backwards. Okay, so the continuous contract, in Ninja that's 6A pound dash pound. Okay, or whatever. You know, TF pound dash pound. It's always a space and pound dash pound. Then the second thing is making sure you have expected movement within a time frame. Because if you're going to choose a binary, you got to have the strike is your magnet price. That's how you're picking your strike. Okay, but then how are you picking your expiration time? Okay, that's going to be your expected movement. And how you're picking whether or not you're actually going to go for that kind of out of the money move versus an in the money move. Okay, that's going to be using something like is actual volume exceeding expected volume at this time. For this month right now, what I'd actually be doing is I'd be using pound dash pound because we just rolled over to 614. So we actually just rolled over to the new month on futures. We actually build that into our scanner. One of the very last tab over there on it will show you. It may have already rolled in, so I think we're going to update the wording because we used wording that was similar to CME's website, which I think is a little confusing. But yeah, so basically, like we use 614 until June 9th of 2014. So you'll use this month until this day, and then you'll go over to September. So right now you should be on 614. Why 10-minute bars? 10-minute bars, I've worked with a lot of big traders, market movers, institutional traders, and for intraday market analysis, when they're trying to like buy and dump, and basically, you know, the market fills orders, where can they get a big order unloaded? They're looking at 10-minute bars for any kind of volume analysis. So it's just something that I've been taught by big boy traders, you could say, big girl traders, and something I've seen has worked time and time and time again. If I go smaller, I get too much granularity. It doesn't really help me. If I go much larger, then it just sort of like blurs everything out. So 10 minutes is just, it's worked for years and years and years as being an accurate thing because, like I said, I've seen other institutional and, you know, large market mover, not market makers, okay, market movers, guys that move the markets go, hey, if I want to unload this many contracts, I have to know where there's going to be volume, and they're very good at reading it, and that's what they're looking at. Let's see here. And then, okay, so is it also an option to use merge back adjusted data, believing that also goes back to fusing the contracts together? Yeah, that's what I'm doing, Michael. So that's what we're doing with the contract. Is either one, you have to pay for the data, or two, you have to have an indicator that will merge the two together. So we're making an indicator that will merge the two together to save you that money on the volume. Time to pay for all the data. So, I mean, either one is fine. They don't care which one you do. It's just either build the indicator or do that. So we're going through and we're building the indicator to actually merge today's data for live data and previous day's data where we're going to use continuous. So you're talking about the options in the, you're talking about here like under tools, options, data, and like merging data over here. So yeah, just you can do merge back adjusted. I just don't know how much it's going to help you. I haven't tested it out, so I'll have to test it out and see. Is that working well for you? For load it up? Alright, well if it is, let's try it out right now. Good. See, I'm always willing to learn new things. I don't care if I've been trading for 10 years, 20, or 40 years, man. I love learning new things. So let's try it out right now. So make some traders I know very happy because they're waiting on this. Let's go in here, data series. Okay, I'm going to drop my 314s. Okay, I'm going to add in I need to roll all my stuff over, but 06-14. Okay, and 6A 06-14. Alright, then we're going to go over here to format 10-minute. We're going to make these two transparent. Right there. Alright, we'll apply that. And then we're going to bump these up on my panels. What I like to do is I like to have my 4-minute. Panel 2, we'll have this on panel 3, get my volume all up there. Then on my expected range on panel 4. Okay. Grab this, move it down here, out of the way. And now, let's add an expected range. Good thing is we'll also build that into the indicator, so that way somebody forgets to check that, and they'll be all set. And then let's make both of these volume based. Okay. And then with that 10-minute, we'll try it out and see if it works. Alright, and then I always put in volume down here so I know what I'm looking at. You get all these ones, they'll all look the same. Change the title. Right there. And click OK. Looks like it's not merging. Maybe I need to restart. I'll reload the data in, see if that pulls up. Is that loading up for you? What I'll do is I'll test it out and I'll put a post in the forum on exactly how to set it up. Okay. But I do see what you're saying, and I think we can get the settings together for it to probably make that work a little bit faster. And I'll watch for a forum post. I'll get that up tomorrow at the latest. But I do see a good way to do that, yeah. How do you use the mouse to move the panel around? You just click on an indicator, and then you can move stuff to if you put it in the middle cell, it'll be like blue. It'll make it a new panel, or you can apply it to a different panel. So I think we could actually do that right here. So right here, we'll take this one, which I want to believe is the 4-minute one. We'll put it up there. It looks like it might be working now. The reload. There we go. I think it did work. All right. Sweet. Yeah. Okay, so now just to test it, okay. Let's go back a little bit further in days and see if we actually are still getting volume. Yes, we are. So far, so good. Thank you, Michael. Appreciate that. There's always little buttons everywhere, man. Awesome. Sweet. Okay, so to go over that, teach anybody how to do that right now, so you can use this immediately. This will save you some time. Is one of the things you can do if you're using the data feeds we recommend that we set up. Okay. Is you can also go to Tools Options. You can go to Data, and you go right here where it says merge policy, and you can say merge back adjusted. Okay? So it'll merge the data for you going backwards. I'm pulling it up. But that should make it a little bit easier than having to go back and always let it continuous. I still like to pull continuous up when we have roll just to make sure everything's working correctly. So I'll watch that and monitor it, and I'll put any forum post up if I see anything that alerts me as that being an issue. But so far it's looking pretty good. So I just want to dive into it and really check and make sure everything's working like it should consistently. But if it is, then I'm all about it. And let's see here. So let's see. I just want to see what I want to do is I want to test and see like if I put the two side by side, if I make like I basically have to save a chart and then change it back to the other method and go to pound, 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 and see what's the difference between continuous and not continuous by doing that. I may even check just with one of the Ninja programmers directly at Ninja and ask them what the nuance difference is. When I find that answer out, that's what I'll post in the forum. So Michael, if you'll remind me to ask Ninja about that tomorrow, and I'll ask them what the difference between merge back adjusted and continuous is, and we'll see what they say, because obviously they'll know better than anybody. They made the thing. Last week, volume analysis. We'll have it in a couple different places. Let's see, go right on up here to home. Let's see, I guess education, webinar recordings, bonus webinars. It'll either be under here, if it was merged in already. Yeah, there we go. Analyzing volume for target price levels. So it's the very last one under bonus webinar series 3. Just use this arrow right here, okay, at the bottom to go to the last one. And that's the one from last week. And that's where I focused a lot on the magnet prices, okay? So I really went into the magnet prices a lot. And I walked through and I plotted and we went forward and we watched how I just nailed them perfectly. Just bam, 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 going forward. Okay? All right, so we got 3 pieces. Again, I want to make sure y'all do walk away with these. One is learn how to look at those magnet prices. That back adjusted may work well. While I'm figuring that out, you may want to use continuous, okay? But so far, it looks pretty good. But definitely you want to have, look at those volume bars, see what the high volume bars were, and mark your magnet prices. Then look at your expected movements. So we give our daily deviation levels. Those are free on our website. You can check those out. But we even get granulars. I mean, you can do 5 minute, 15 minute, hour, hour and a half, whatever. And then the next thing to add in to go and look at is, do I actually expect it to exceed that volume this hour? So, or that, that expected move this hour. And so that lets me know whether I want to do like an in the money or an out of the money contract when I do it. Or maybe I want to do both, which it's called a double binary strategy, where I can do an in the money and an out of the money. So if it stays flat, my in the money covers my out of the money. If it goes against me on my in the money and it actually does reverse, then I could still make money on my out of the money and cover the loss and maybe make profit potentially. Or if it takes off, I can make money on both sides. So, and I can limit my risk either way to about $50. So by doing a double binary, but I could make as much as 100 by doing a double binary. So there's a lot of cool ways that you can combine these contracts together. And I go through a bunch of different strategies. I usually stick pretty simple to in the money, or out of the money, or sometimes I do strangles. Very rarely do I do strangles. I'll do straddles a lot on news, but by combining all this together, it'll help you become a better trader in any trading system you use, because you'll have correct expectations of movement, correct expectations of how long it'll get there, and if you expect it to get there fast or slow based on volume and what it's doing. So I hope those 3 pieces help you. This is sort of an advanced webinar series. We've done these last 2 sessions on really, digging into volume. If you look at last Thursdays, I go into it, and I'm actually looking at live markets. There's obviously more volume happening during the day than at night. But you can use it anytime, day or night. But I'm going into live markets and talking about this. and we literally watch it do exactly what we say it's going to do based on the volume. And that's under just the Thursday AM webinars, and right here under webinars, and then Thursday AM webinars. And I was covering the expected versus actual volume, and we dug into that a lot. So right there, and let's see. And if you have any questions, if you're ever trying to find one, just post in the general trading forum, and we'll reply to you where it's at. Okay. And the best place to watch that one would be under Boomerang, I think. I think that's where Mark put it. Because the main reason we use that is Boomerang here. Under System, and under Boomerang Trading Strategy. And, yeah, this right here, the start to finish video. It's a good place to check out. Like, that'd probably be a very good place to start. So I'm sort of assuming though that you watched the first one. The first one I explain what the boomerang strategy is, and this one I go into like really how to fine tune it. So, and then in the third one I'd probably watch the magnet prices. So you start mastering. There's 3 areas that you need to master as a trader. You need to master price, action, like actually determining what price, what direction something's going to go, okay, and how far. But you need volume. You need to master how to read volume, and you need to master expected movement. So you have price analysis, volume analysis, and expected movement analysis. And so we're teaching you how to do those 3 things. Those are the 3 pieces you really need to get down. And we talk about how to make that as simple as possible. All right, let's see here. Any other questions I can knock out for you? Before we close it down. I'm going to try to get that link. The links don't work when they come to me for some odd reason. Let's see here. Okay, I found it. Yeah, thank you. To understand volume better, I would go through 2 videos. I'd go through one, this one to start to finish, and I'd go through the one from last Thursday. Sorry, last Monday, the bonus webinar that I just showed you. So again, education, webinar recordings, bonus webinars, the very last video. And then go to questions, forum, system, boomerang, and then go to the webinar from A to Z. Okay? And that'll help you. And then adding this piece on. So this webinar, again, it's a 2nd-part series of last week's webinar. So without last week's, it's a little bit, you're sort of like, what's going on a little bit? I know that. So I want to make sure you know where to get that information. Okay? But it's basically just using volume analysis to know where the market is going to go to when it does move in that direction. And how do you do that with continuous contracts? Because that's a big gap that a lot of people have. Now, next week we're going to go to a little bit different topic. We're going to talk about breaking down the binary. And I'm going to actually go into what makes a binary, what makes a contract, how does it work, how does the price move, you know, how does that help you as a trader in knowing what strike to choose, what contract to use, okay? So, you know, a lot of people are like, well, 0 to 100, I get that. I get that it's 0, 100, or 50, you know, but how do I understand all the in-betweens? So we're going to go into like breaking that down again, you know, focusing a little bit more on the advanced, and then we'll come back around to some more basic things. But I want to, you know, I try to sort of go off and on. You know, I'll go 1 month on where we give some basics, some reviews, and then 1 month we'll go like really advanced. So this month it's been more an advanced month, and I'm trying to meet, you know, everybody's needs. We got new traders coming in. We have traders that have been trading a long time, always wanting to, you know, improve. So but next week we're going to really break down the binary. What does that price come from? Okay? All right, well, if y'all have any questions, this then let me know, and I will be glad to help you out in any way I can. Definitely use the forum, and I see there's a lot of posts on there I've been out, but I'll catch up on them, and be glad to help you out. All right? Awesome. Y'all are welcome. Y'all have a great evening. Thank you.